An index fund is one of the simplest ways to invest, and most people don't realise how powerful simple can be. When people first start investing, they often assume success comes from picking the right company or the next big winner. The right share, the right sector, the right moment to buy. But there is another approach that doesn't rely on prediction, doesn't require constant monitoring, and doesn't try to outsmart the market. That's what we're talking about today. What an index fund is, how it works, and why it has become such a widely used investment approach in Australia. Before we talk about index funds themselves, we need to understand what they are actually copying. The share market is simply a collection of companies that investors can buy and sell shares in. In Australia, that includes banks, mining companies, retailers, healthcare businesses, and technology companies. Some are very large, some are smaller, but together they form what we call the Australian share market. Because there are hundreds of companies, we need a way to measure how the market is performing. And this is where an index comes in. An index is simply a list of companies used to track how a particular part of the market behaves. For example, the ASX 200 is a list of the 200 largest companies in Australia. It is not an investment by itself, it is simply a measurement tool. If those companies rise in value, the index rises. If they fall in value, the index falls. It functions like a scoreboard for that section of the market. So what exactly is an index fund? An index fund is an investment that copies that list of companies. Instead of trying to choose which businesses will perform best, an index fund buys all or most of the companies in the index. It tracks the ASX 200, it owns those 200 companies. If it tracks a global index, it may own thousands of companies across many countries. It does not try to predict which one will outperform. It does not jump in and out of markets based on headlines. It simply mirrors the index. A simple way to think about it is this. An index fund owns the market rather than trying to beat it. That is the core idea. And this is where things become interesting. Because once you understand that idea, the rest of the structure becomes much clearer. An index fund does not try to find the next big thing. It does not pay analysts to predict which companies will grow faster than others. And it does not make frequent trading decisions. Instead, it follows a rules-based approach. If a company grows large enough to enter the index, the fund adds that company. If a company shrinks and falls out of the index, the fund removes it. The process is systematic, structured, and disciplined, and that simplicity is entirely deliberate. Now let's talk about why this approach actually matters. The first reason is diversification. When you invest in a single company, your outcome depends heavily on that one business. If it struggles, your investment often struggles too. But with an index fund, you own many companies at once. If one company performs poorly, others may perform well. And you're spreading risk across the broader market rather than concentrating it in one place. That does not remove risk. The share market still moves up and down, but it does reduce the impact of any single company failing. But the important part many people miss is this. Index investing doesn't remove volatility. You still experience the ups and downs of the market. What changes is how you participate in it. You are not relying on one company, one manager, or one prediction being correct. And for long-term investors, that difference matters more than it might first appear. The second reason is cost. Because an index fund is not trying to outguess the market, it usually requires less research and less trading. That often means lower fees. And fees matter more than most people realise. Even small differences in annual fees can compound over long periods. Lower costs leave more of the return working for you. Over 20 or 30 years, that difference can become very significant. The third reason is behaviour. Many investors fall into very similar patterns. They chase last year's best performing fund. They move money based on headlines or short-term market movements. They try to guess when to enter or exit the market. These decisions are often emotional. An index fund reduces the need for constant decision making. You're not asking which company to buy next. You are simply participating in the overall market, and that structure can help reduce common behavioural mistakes. This is where the real difference appears, because investing is not only about numbers on a spreadsheet. In practice, what tends to matter more is whether someone can actually stay invested. A strategy only works if a person can stick with it, and a diversified, rules-based, low-cost approach often makes that easier over time. The fourth reason is expectations. An index fund does not promise to outperform the market. Its goal is to match it. And while that may sound unexciting, broad markets have historically delivered meaningful growth over long periods. The goal here is not to be the best performer in any single year. It is to capture steady market growth over decades. That is a very different mindset, and for many investors, a very useful one. Diversified and low cost. Simple does not mean unsophisticated. Very often it means disciplined. Let's make this practical. Imagine you invest in a single Australian company. If that company performs well, you benefit. If it struggles, your investment may fall significantly. Now imagine instead that you invest in an index fund tracking the ASX 200. You now own a small piece of 200 different companies. Banks, retailers, healthcare providers, mining businesses, and technology firms. Some will perform well, some will not. But overall, you're capturing the performance of the broader Australian economy. It is less dramatic, but structurally, it is more stable. And that is often the point. And once you see how this works, the Australian context becomes clearer. Many superannuation funds in Australia use index funds within their portfolios. Some options are fully index-based. Others combine index funds with actively managed investments. If you log into your super account and see terms like Australian Shares Index or International Shares Index, those investments are typically using index funds. Understanding that can help you make better decisions about fees, diversification, and strategy. Quick reminder before going further, the information I'm sharing here is general in nature and does not take into account your personal circumstances. Before making any financial decisions, consider whether the strategy suits your situation and seek personal advice where appropriate. So stepping back for a moment, the central idea behind index investing is actually quite simple. You're not trying to beat the market, you're trying to own it. And for many long-term investors, that shift in thinking can be extremely powerful. An index fund does not try to be clever. It does not rely on predictions. It simply owns a broad section of the market at a relatively low cost. For long-term investors, that combination of diversification, discipline, and simplicity can be effective. It may not feel exciting, but investing does not need to be exciting to work. Often the steady and structured approach is what quietly delivers the most consistent results over time. If you want to implement this properly, I help Australians structure this every day. Details are below.